Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry market analysis and trade ideas webinar. It is currently roughly 3:50 p.m. Eastern, winding down the North American trading session midweek Wednesday, July 5th. Now, keep in mind, we are still early into the start of the new business month and new business quarter. And of course, we had some North American holidays to start off the week and relatively unimportant economic data. So we have seen less volume and volatility compared to other prior weeks so far. But the second half of this week does look more eventful, and we should see some increase in volume and volatility up until the end of the week, in my opinion. Now, when we're doing our market analysis, we've already been looking at some key price points across the board, overall fundamental sentiment, intraday waves and changes in price, and of course, economic data that can impact what we are focusing on. From a macro fundamental perspective, central bank monetary policy has been the main driving factor, and what we have been taking advantage for dollars still remaining relatively more on the bullish side as Feds look to keep rates up in a restrictive stance and follow their methodology of rates up higher for longer to ensure inflation reaches their goals of 2% and maintains at 2% for a significant period of time. We can also see central bank monetary policy being the main driving factor as yen is still extremely bearish on Bank of Japan, keeping financial conditions very loose and sticking to their ultra loose monetary policy and not shifting out of it yet, or not even seeing any Japanese government currency interventions. And we can take advantage of these rate differentials very clearly as we're looking at USD JPY still being very bullish, GBPJPY still being very bullish, and potential to start to see some dollar strength and sells on GBP USD and Euro USD if we have the confirms, as well as USD CAD bounce buys as crude oil still remains below $80 a barrel, weakening that correlation of strength between crude oil and the Canadian dollar. And we're still seeing dollar on the higher time frame. We're looking at the dollar index holding well above that 102 key price point we've been looking at on a weekly and higher time frame perspective. Now, market focus coming back to rates being up higher for longer, which we've even seen solidified with the FOMC meeting minutes today, even though it didn't hold any impact because it's really nothing new being brought to the table. This is still keeping some demand in the dollar, and this is still keeping equity markets, stock market buyers at bay. In the example of US 30, you can see we're still stalling out at this liquidity zone at 34,500, where I only see safe buys on US 30 above 34,500. And in the example of dollar would need to be breaking back below 102.8 on the intraday to show that the markets are waving off rates being up higher for longer. We can also see volatility index starting to create a bit of a support. The same time, we're starting to get some give back in the equity markets, meaning it does look like some of the stock market greed is starting to fade. And I can only be confident in stock market buys above 34,500. Otherwise, I'm more short there. On dollar, I'm more bullish on dollar, holding above 102.8 and breaking above 103.5. Japanese yen, I still remain relatively bearish on the yen as we don't have any new fears, uncertainty, and doubt. We have not had the Japanese government perform any currency interventions. We still have the market riding the wave of Bank of Japan maintaining their ultra loose monetary policy. This can be seen very evidently as Japanese yen individually is very bearish in structure and price action, where the ultra loose policy and continued stimulus is still keeping the Japanese stock market in much cleaner bullish market structure and bullish price action compared to the majority of other equity market regions where UK 100 is still slumped, German DAX and Euro stocks are still seeing that exhaustion. Asia Pac is mixed when you're looking at the Australian stock market index, and US 30 in the example of North American equities in the US is still holding and rejecting below 34,500. So outside of obviously the Bank of Japan keeping their monetary policy loose and continuing to stimulate their markets and economy, it looks like the majority of other stock market regions are starting to see that greed and optimism being faded out, and the reality starting to slowly settle back in of interest rates from the majority of major central banks being up higher for longer. When you're looking at the Bank of England, Reserve Bank of Australia, Bank of Canada, ECB, Federal Reserve, looking at on average across the board, rates maintaining above 4% for into 2024. Now, as we haven't had much economic data to start off the week, and we're still just primarily playing these risk flows, a quick summary of events is I'm still bearish on most equities now outside of the Japanese stock market. In the example of US 30, I'm short below 34,500, only see any safe buys above there. You can see at this very important price point of interest, it's held weight both during the stimulus and money pumping phase in the markets and as the Fed started to do their most aggressive rate hike cycle, which we can see in this general area. Or, of course, when they started front loading rate hikes, we've still had trouble of equity market buyers trading above there, showing that there's not that much confidence in a bull market just yet. For us as manual retail traders who remain objective to trade both sides of the market, we got very clean-cut confirms to be taking buys with breaks above 34,500, and of course having confirmations of the markets starting to fade out, rates being up higher for longer, looking even more forward into the future as these greedy crackheads with capital do, and starting to price in future rate cuts. If we have data to support that, then we can see breaks above 34,500. Otherwise, at the end of this week, we have US labor market data in focus, unemployment rate, non-farm payrolls, and your wages information. If the labor market is still remaining relatively tight, it just further cements the central bank, Federal Reserve's monetary policy of keeping rates up higher for longer, as they're still going to keep the focus on bringing inflation down towards their target. And a hot labor market just supports that sentiment. So that's going to be really in focus at the end of the week there. But from quick summary points on the intraday, I'm still bullish dollar above 102.6 to 102.8. Even further bullish if we break above 103.6. I'm still bearish on the yen below 69.5 or breaking below 69. I'm still short on US 30 Dow Jones equity markets below 34.5. Only see bulls above there. And as we have a bit more demand in the dollar, markets starting to focus on rates being up higher for longer, we haven't really had any major fear, uncertainty, or doubt or recessionary scare data that's bringing major demand into gold on its safe haven appeal side. With gold, even though the macro case for gold bulls is still very strong, we're manual retail traders who primarily day trade and scalp trade in these markets, right? So from a day trading perspective, we have to understand it's very common for an asset class such as gold to do very aggressive pullback waves and corrective waves. We have to highlight some very important price points of interest like the 2000s, which we're still holding below, the 1930s to 1940s, and then our next area of interest into the 1820s. When we're looking at gold here, obviously the base case for higher time frame bulls is growing as you have global economies entering deeper recessions, as you have declining economic data and expectations of slower growth in a higher interest rate environment, as you have rising geopolitical tensions, still uncertainties regarding the banking sector across the globe, and more failures that can come into play. The overall macro base case for gold bulls is for sure growing, but that doesn't mean we want to jump in prematurely and get caught in one of these aggressive pullback or correction waves. When we're looking at key price points of interest, if you get new fear, uncertainty, and doubt, bad data, and breaks above 1940s, That's just easy continuation buys. But if we don't get that, gold over the next period of weeks or months can easily be making its way back down into the 1820s and 1830s before seeing buyers really enter the market again, where you would want to be taking advantage of this correction and downside. Right now, some of the supporting factors for correction and downside is that there's expectations the labor market can still be relatively tight at the end of the week. Factory orders and durable goods data has been more to the optimistic side. We're still seeing some demand in the dollar due to the markets, which shows us that the markets are still focusing on rates being up higher for longer. The same time, we're still seeing equities subdued below 34,500 in the example of US 30. We had a nice pullback today to the 1930s, retest of previous intraday lows. And if we also start to clear below these wicks, seeing gold in this corrective phase to retest better buy zones would not be out of the ordinary. So right now, this gold bearish structure on the higher time frame and intraday is holding more weight and being supported by sentiment and data as well, with a bit more demand in the dollar and obviously having some more optimistic data short term, and the market's focusing on Federal Reserve keeping interest rates up higher for longer, which is a bearish fundamental factor for an asset class such as gold. So we could easily still see intraday plays into the 1830s, 1820s before buyers come into the scene. If we don't get these confirms of breaking out of structure, coming above the 1940s and supporting with fundamentals of either new fear, uncertainty, or doubt, continued bad economic data, and alongside the break of structure for both technical and fundamental confirms to increase confidence there. Other than that, anything against the yen, especially if the primary in the quote is still raising rates or keeping rates up, like USD JPY, Euro JPY, GBP JPY, I'm still more to the bullish side. You do have to be mindful and watch out for any currency interventions that can occur. But understanding currency interventions, it's not about the prices that USD JPY or the Japanese yen may be at. It's about the speed that the Japanese yen depreciates at. If you have increased volatility, meaning massive short selling on the Japanese yen and very aggressive devaluation and depreciation of it, right? That's when the Japanese government steps in. We haven't seen surging upside on UJ or GJ. We've been continuing to creep bullish while having these short-term intraday corrective waves in a very slow and steady and consistent manner. It's not really high risk volatility by any means. And we're already in the example of USD JPY, still having a consolidation at these highs with very strong bullish structure. And we still want to play that macro rate differential of the Bank of Japan still keeping interest rates in the negative and monetary policy ultra loose, while the other major central banks are still sticking to keeping rates up higher for longer. And on the opposite side of the spectrum, which is the reason and the main driving factor why UJ's been so bullish, GJ's been so bullish, Euro JPY's been so bullish. On dollar pairs, I do want to start to see dollar strength coming back into the table and breaking to the downside of these consolidations on GU and Euro USD, and UCAD continuing more bullish. And those are just some quick intraday summary points. Now, before we jump into the exact trade ideas and analysis, we still want to understand what events we have in focus. So tomorrow over the London and European trading session, we have some construction PMI figures, all sector PMI for the UK, and retail sales for Eurozone. Now, overall global PMI figures have been contracting and declining as economic activity has been dealing with the constraints and environment set up of higher interest rates, and that taking its path, trickling through the economy from all the way to the top with banking to all the way to the consumer and their debt that they owe, the cost of living, and so forth with inflation and everything down the line. So PMI figures have been contracting, but majority of these European and United Kingdom PMI figures are already well below recessionary scare points, and it's already expected that this data has been poor. So it wouldn't be out of the ordinary of just getting some neutral data in the essence of it holding minimal market impact, maybe just a lower time frame whipsaw. We have some overall comprehensive risk reporting for Q3 for Germany, France, UK, and other parts of the Eurozone here at 5 a.m. Eastern. I don't think that'll hold too much weight. It's not going to see a major change from prior. And then we got some important data during our North American trading session, which will probably be our main driver for sentiment tomorrow. We have ADP national employment, which is your private sector jobs reporting, expected to show a pretty normal decline. We have initial jobless claims expected to show a little bit of an increase. And then we have PMI figures from 9:45 and 10 a.m. still expected to be relatively solid above recessionary scare ranges. We may see the labor market softening a little bit at the initial start of the North American trading session and COMEX open at 8:30, but then PMI figures here still be above the 50 grade point and still lead to a bit more demand in the dollar and markets still focusing on rates being higher for longer. In my opinion, to really see gold buyers come into the scene and dollar bears, we would need recessionary scare data across the board throughout the entire session from 8:15 all the way into your ISM non-manufacturing and JOLTS jobs openings at 10. But expectations of the labor market softening is already well known. Markets price that in my opinion, from the signals given by obviously the Federal Reserve and their forecasting of already expecting labor market to weaken. So that's going to be a fun North American trading session Zoom we're doing. Nothing else really going on. We got Lori Logan at 8:45 just to keep an eye out on headlines. Now, when we're looking at gold here, we understand those key price points. 1940s is an important price, 1820s and 2000s just as your main intraday areas of interest. Right now, we're still respecting this bearish market structure where at the end of the day, we've just had a pullback from these new lows being printed, and bearish market structure is not highlighted by a subjective trend line, which you can draw 10 different ways. Market structure is confirmed by objective price points. So from these lows here, we had the order accumulation from this price point roughly into the 1930s, which you can see is a significant zone across the board. After this low was printed, we had a pullback phase, more sell orders accumulated, and short power to lead us into these lower lows. Bearish market structure and bears in control on the intraday is still being respected as long as we're below that price point. And it's very common for gold to have these pullback phases and this overall structure, which can last sessions, days, and be hundreds of pips, but still not break this sequence of events. So when we're looking at gold here, I'm still short on gold and expect us to revisit into the 1890s before seeing any type of bounce, or going even deeper into the 1830s and 1840s. Would only see safe buys with a collection of bad economic data, any new geopolitical tensions overnight that bring market fear, uncertainty, or doubt, and change risk flows to bring more appeal to gold safe haven side. And I need technical breaks above 1940. Otherwise, I'm a bit more short there, where we might not see a significant bounce or buyers in play until we go into the 1890s again, or of course into the 1820s, 1830s. So bringing that information together to the table, we've also had some great trade ideas play out from our North American trading session and last analysis from the sells from 1930s and 1925 down, which is playing out very well. We just had this short-lived liquidity grab, but still had the intraday candle bodies closing below 1930s and that liquidity zone, showing me sellers still in control. Pullbacks to retest into the 1925s, breaks below these lows printed through the end of the North American trading session, breaks below 1912s, I would still be looking for these gold sell plays. Optimistic data would further support this as well as the market focus maintaining on rates being up higher for longer. I only see safe gold buys from current price points that we're sitting at with a shift in structure and clean breaks above 1932. Main intraday bias for now, understanding higher time frame price positioning, and of course, how we're still early into the new business month and business quarter and the current structure goals respecting. Now, USD JPY, we're just in a secondary phase of market structure, which is a consolidation or accumulation of order flow at these highs. Very similar to this situation here, where you're not always going to get something like this and just an aggressive pullback phase to accumulate more orders. You can easily have these consolidations, which creates a lot of trader doubt, indecision, thinking a top is in while you still continue up the trend. So USD JPY, GBPJPY is still very bullish, playing that macro rate differential. Obviously, we want to mark off within our higher time frame key levels here that bit of a consolidation low, as if we trade below there, I could see deeper pullback phases. But overall, in structure, in fundamentals, understanding the macro rate differential, GJ is very bullish, has increased probability to go up into 146s and 148s if we don't have any new fear, uncertainty, or doubt. Any bad economic data has just led to these intraday data-induced pullbacks. It does not break the overall bullish structure. We haven't seen any Japanese government currency interventions. We're not getting any major geopolitical tensions to the table that's holding market weight. Everything's just been majority noise from a reactive standpoint. Safe continued buys on UJ above 145, 145.5, and breaking of these range highs, just continuing the trend. Would only see a short-term pullback with clean intraday candle closures below 144, which I would see us revisit 142.4 into this rough area here before seeing buyers come into the market again. So I only even see a chance of a pullback phase or a minor correction if we don't print any new highs, have very bad data, breaks below 144, and that would be pretty short-lived in terms of the overall market structure and intraday pricing, just to see buy orders accumulated from lower demanded prices at 142.5. GJ, similar idea. I only see short-term intraday sell plays or scalps below 183.2, which I would see a pullback into this accumulation zone to the left at around 182.2 before continuing higher. Otherwise, starting to look for some of the breakout continuation buys. Still have the Bank of England keeping rates up higher for longer. UK inflation is not declining at fast of a rate compared to North American inflation. We still are playing the ultra loose monetary policy of the Bank of Japan. Just need to keep an eye out for any reactive currency interventions. But the probability of currency interventions is low if we continue to chug away in a slow and steady manner. and don't have increased excessive volatility on Japanese yen weakness. Just keep in mind some of those UK and Eurozone PMI figures, which are already expected to be poor. So if it's just coming out still around the prior, I don't think it's going to hold that much market weight besides maybe a lower time frame liquidity grab. Now with dollar pairs, GBP USD is still relatively bullish here, but if I see dollar strength come back into the table and we cannot print any new higher highs here, and especially if we break below this price point at 1.26, seeing a larger corrective wave on this GBP USD upside as dollar domination can come back into the table would not be out of the ordinary and is very common and something you want to stay adaptive to. So right now we are seeing exhaustion by GBP USD buyers at this price point at 275, just entering an intraday consolidation where if we break below the consolidation lows and break below 2.6, especially with fundamental factors to support dollar strength, like still having a relatively tight labor market, markets focusing on keeping rates up higher for longer, that obviously translating to dollar index trading back above 103.5 and 104, we can easily still see some GU sells in the table here. Now, overall, we're just dealing with this consolidation where I'd be looking for either breaks above here, short-term sweet buys into better sells, or just starting to look for the sells below 269, 266, and 263. This is going to be a very similar idea on Euro USD, as Euro and UK economic data has not been too far off from each other. Same with central banking monetary policy. I'd still be looking for the higher risk, higher reward sell. Main bias, though, is if dollar maintains above 102.5, more fundamental confirms for upside would be breaks below 269, 266, and 263, at least to revisit into these lows, which is solid intraday ranges to take advantage of. Euro USD, similar idea. Difficult for me to see any more Euro USD buys unless we're trading above 1.093 key level. Otherwise, I'm just looking for new daily candle price setups that can usually occur through Asian or even London overnight, and some of these continuation moves for some sells. Only see Euro USD buys above 1.093. Overall on Euro USD here, when you're looking and zooming out, you can still see we're starting to show after the dollar domination phase, when in 2021, first Russia was invading Ukraine, which brought demand into the dollar as your world reserve currency, then Fed's front-loaded rate hikes, we had very smooth, steady, consistent downside, breaking below previous significant lows here from 2020, going to below a parity point with the dollar. This has been a rough 50% correction of that macro move and starting to show major signs of exhaustion by buyers and sell orders being accumulated here if we can no longer trade back above 1.1. Potential to start making our way back down to 1.06, 1.04, and so forth. At the same time, there's more evidence for demand to pool back into the dollar. And those intraday confirms. So I would only see Euro USD buys back above pretty much 1.095, 1.0985. This leads into having more of the inverse on USD CAD, where on USD CAD, we're coming back above an important weekly demand zone after still respecting overall macro bullish structure. If we can come back above these levels at 1.33, still have more demand in the dollar, oil remaining relatively softer, we still have more focus on the US dollar as your world reserve currency and the rate hike path that the Federal Reserve is going to continue to take rather than the Bank of Canada. And if we fail to break below here, starting to see buyers come back into the market would not be out of the ordinary at all. I would be looking for, as we had an accumulation here, retest. Hopefully nobody's experiencing sound issues 40 minutes into the webinar. I hope somebody would have said something about that. I'm going to be looking for these continued USD CAD buys, only sells below 1.32. Last but not least, US 30. Now, safe US 30 buys for me is if we can finally clear above, show continued bears in the volatility index, and finally break above that liquidity zone we were talking about and very important price point at 34,500. Otherwise, I see stock market shorts below 34.3, 34K, and 33.8. Starting to see some of the greed and optimism dissipate from the markets, the upside being subdued, market focus coming back to rates being up higher for longer. Optimistic and tight labor market data can still further support that. Still trading below that important liquidity zone at 34,500. VIX starting to create a little bit of an intraday support as well. Potential to see a change in risk flows. Would only see buys above 34,500. All right, everybody. So don't want to make these too long because it's just market update and trade ideas, but I'm going to save and upload this. Make sure you still stay smart and vigilant. Follow your trading plan. Follow your risk management plan. Have a long-term vision rather than being short-sighted. Focus on taking trade setups with a positive risk versus reward ratio so you have room for failure and inevitable losses. Keep in mind, we still have relatively low volume and volatility, and most likely will be that way until the next North American trading session, where we got some US jobs data with jobless claims, private sector ADP reporting, and some PMI figures post NYSE hours.